So now let's turn our attention to the cash budget. Looking at Hogarth Incorporated's cash budget for the year, we begin Q1 with last year's ending cash balance, which is this year's beginning cash balance. And in this case, it's $38,000. Based on our schedule of cash inflows resulting from revenues, we expected to collect $253,000 in revenues during the Q1. Some other receipts are planned as well, and we didn't talk about that in a specific schedule, but let's just assume that there's $2,000 of additional collections that occur that are included in the cash budget. That means that the total cash inflows during Q1 is $255,000. Now the cash outflows correspond to the costs, and we calculated cash outflows and disbursements for materials, labor, overhead, and we talked about cash outflows for selling and administrative expenses. We also have cash outflows for income taxes. Total outflows for Q1, per all the schedules in detail, is $265,859. So beginning with $38,000 and counting the cash inflows of $255,000, and then subtracting the outflows of $265,859 leaves us with a balance of $27,141 in cash at the end of Q1. Let's assume that that surpasses the required threshold of cash on hand at the end of any accounting period, and that is $25,000, identified by upper management of Hogarth. So in that case, we don't need any further financing for this quarter's activities. We have enough in the beginning cash balance to offset a little bit of the deficiency that we have from between the cash inflows and the cash outflows for this quarter. The ending cash balance for Q1 is $27,141, which will then become the beginning cash balance at the beginning of Q2. Turning to Q2, we have the same set of information. We projected cash inflows to be $304,000 for our revenues. That's the only inflows that we have, and those are offset by the cash outflows for materials, labor, overhead, selling and administrative expenses, and the income taxes that we owe for this quarter. Those cash disbursements total $298,557. So the beginning cash balance of $27,141 plus the inflows of $304,000 less the outflows of $298,557 leave us with a cash balance after operations of $32,584. Again, our cash balance after operations exceeds the required threshold of $25,000, so no further financing is needed during Q2. We roll this information forward in the same process for Q3 and Q4. The ending balance at any one quarter becomes the beginning balance for the next one, and the same process applies. Now, one thing that pops up in Q3 is the fact that our disbursements or cash outflows exceed our inflows by a substantial amount, and our beginning cash balance at the beginning of Q3 is not sufficient to keep us above the $25,000 threshold. In fact, we're down quite below that at $6,145. And then this problem seems to continue in our projections for Q4. In fact, we expect a negative cash balance at the end of Q4, which of course is not in line with our threshold at all. So let's go back to Q3 and think about what managers would do in that situation. In essence, our cash budget has suggested that there is a need for financing in Q3. And suppose to bring the cash balance at the end of Q3 in line with the threshold of $25,000, they take out a flat loan of $20,000. That, combined with the cash balance after operations that's available to them, leaves them with $26,145 in cash balance at the end of Q3. However, this is not enough to offset the deficit in cash flows that we have in Q4. Even if we borrow the $20,000, it's not enough to bring the Q4's ending cash balance above the required threshold. So obviously we'll need further financing in quarter 4. As a matter of fact, there's additional bad news in the sense that we can expect that on the $20,000 that we borrow in quarter 3, we would actually have an additional cash outflow for interest on that loan. And perhaps we even have to pay back some of the principal in quarter 4 as well. So, the cash budget ultimately allows us to see the need for financing. The budgeted income statement and all of the associated cash inflows and outflows build the cash budget. And looking forward into quarter 3 and quarter 4 in this example, we see the need for financing. In the next lesson, we'll talk about how what we learn via the cash budget feeds back and influences the previously considered budgets. So as you can see, managers can learn a lot from the cash budget. In quarters 3 and quarters 4, we learned about potential financing needs that were going to occur later on in the year. In the next lesson, we'll talk about how what we've learned from the cash budget will help us feed back and influence and reconsider a lot of what went into the creation of the budgeted income statement.